Hello, everyone, and welcome to the December 2022 issue of the Zavitz and Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner, Mark Zavitz. Today, we're going to be quickly going over performance before highlighting some important financial and tax changes that are coming through the pipeline in 2023 that we think will affect you and are important for you to know. So real quick with respect to model performance, over the past month or so, we've actually seen quite a nice rally in equity markets. Yields have also come down in bonds. When I was showing this slide to you in our previous updates, the growth portfolio was down around 14%. Now it's down around 10. The moderate portfolio was down around 10 to 12%. Now it's down around 7.85. The conservative portfolio is down a little bit more, and that's only because one of our moderate portfolio positions has performed so well. It's one of the equity positions in there. It was down around 10 to 12%. Now it's down around 8, and the conservative was down around 8, and now it's down around 6. We've had quite a nice rally. Mark, what have you seen over the past month that has contributed to this rally?
Well, Greg, similar to about 2.5 months ago, the central banks, particularly in the States, have indicated that it looks like we're getting close. That they've indicated that inflation has peaked. It's starting to come down. The markets are not quite as concerned about interest rates going up significantly more. So, that's put a nice positive spin on things in the last 6 weeks. Hopefully because of the interest rates, looking like they're pretty much as high as they need to go with the central banks, maybe 1 or 2 more increases. The bond market has rallied significantly, and that is why the very conservative portfolio has moved from, a year-to-date return at one point, which was close to -9, down to -6, as we had a really big rally in the bonds inside all the portfolios, but the very conservative portfolio has a very significant component of bonds.
Yes.
And that has, provided support for the equity markets. The equity markets are, they react very often off of the bond markets, and because the bond markets have calmed down, the equity markets have rallied as well. And so we've got, for the second time this year, both stocks and bonds going in the right direction at the same time, which is kind of nice.
Yeah, it has been nice, and we haven't fielded too many concern calls from some of our clients about performance, but nonetheless, I know since most people have been through a few of these corrections, it's never pleasant to go through. However, we were kind of predicting this type of outcome 5-6 months ago, that there was a strong probability chance, just reading the tea leaves, that we were going to experience a late year rally or beginning of 2023 rally. So it looks like that's happening right now as inflation starts to roll over. And again, as we've said many times, the market is looking forward about 6 to 12 months to what the end of 2023 is going to look like for companies, and how it's going to be, I guess, from an economic standpoint for stocks and bonds. So it's already kind of forecasting and taking into consideration the fact that they think inflation is going to be coming down. Now, what could also happen is that inflation doesn't come down, isn't actually rolling over, and we could experience what's known as like a head fake, where we start to see inflation start to pick back up again. We don't know what's going to happen, but as far as it looks right now, it looks like we peaked in inflation, which is a good sign. And as long as this trend continues, we should experience some really strong returns into 2023 and into 2024 for equities and for bonds.
Great.
So when it comes to tax numbers and the financial updates that we want to provide you for 2023. First and foremost, our lovely TFSA. The limit for the TFSA is increasing to $88,000. It's a lifetime limit. It's going up $6,500, quite a substantial amount. For new investors, if you're just getting started, it almost always makes sense if you're young to contribute to your TFSA, especially if your income is below around a $50,000 threshold. So start using your TFSA to invest. For everybody else, we've got investors and clients with TFSAs that are well into 6 figures now. So, over 100,000, 115, 120,000 with some market growth. And that's only going to increase over time as we continue to see the TFSA limits increase. And that limit is tied to inflation. So if we have another strong inflationary year in 2023, I wouldn't be surprised if the TFSA limit going into 2024 increases to $7,000, which is nice. RSP contribution limits, we still have quite a few clients contributing to their RSP. The limit is increasing to a maximum of $30,780. In order to qualify for a maximum RSP contribution, you need to be making or claiming $171,000 of employment income or rental income for the year. One that is relevant.
Greg, Greg,
Yep.
this is just sorry to interrupt, but that 171,000 of earned income is required because the RSP limit represents 18% of earned income to a maximum of 30,700. So that's just, I just wanted to mention that's the reason 171 is required.
Beautiful, thank you. And numbers that are quite relevant to many of you. OAS clawback, that threshold is increasing by about $5,000 next year. So too is the amount that is the maximum amount before you don't get any OAS. But the relevant number here is the $86,912. That means that it's actually tied to inflation. That means that before around $87,000, you're not going to have any OAS clawback. Once you get to around $87,000 of income, every dollar you incrementally make after that experiences around a 15% clawback from OAS. So it's nice that it's going up. So we're going to see some reprieve. If your income hasn't changed, but it is in OAS clawback territory, you are going to be collecting more OAS next year. So if you had $100,000 of income and you're a retiree and you're in partially through OAS clawback thresholds, you are going to be seeing less clawback in 2023 when you file your taxes. Basic personal amount increasing to $15,000. Simply put, this is the amount that you can earn as income in Ontario, ballpark, where you basically don't pay any income tax. Tax credits cover basically everything that you make. So if you are lower or a low income earner and you make $15,000, you really don't pay anything because of the provincial and federal tax credits that are available to you. So this slide just shows the changes to the combined federal and Ontario tax brackets from 2022 into 2023. So 2022 is on the right and 2023 is on the left. What some people don't know about our progressive tax system and our progressive tax brackets is that they are also tied to an inflation calculation. And as a result of that, let's just say your income hasn't increased or hasn't gone up to the amount that you'd like as a result of your employer not matching what inflation is, which is quite standard. Well, you are going to see a bit of reprieve since the taxable income brackets are also increasing, which means that if you make a fixed amount from an income standpoint, you're actually going to be paying a little bit less tax. And I did some math to show what I mean. So if you've got an income of $85,000 of employment income in Ontario in 2022, based off those tax brackets I was just showing you, you'd pay roughly, not including any credits or refunds, you'd be paying around $20,612 in tax. Now, because of our tax bracket increases and the thresholds moving, being tied to an inflation calculation, you're only going to pay on $85,000 of income, roughly around $20,249 of tax. So you're going to be saving $362 of tax. It's not a lot, but it is something nice, especially if you haven't seen that nice raise that you were hoping for. You are going to be paying a little bit less tax on the income that you earned. So some of you may have heard of this, the tax-free first home savings account. This has been tabled. It was part of the budget agenda when it came out early in 2022, but it's been spoken about by our Minister of Finance a few times in some of the press releases that have come out, but nothing is fully set in stone yet. The only thing that has been set in stone, I think, are the limits. $8,000 per year contribution limit is what's set in stone for 2023, with a potential lifetime max of $40,000. That's all we know for sure. We don't know how it's going to work with the first-time home buyer RSP withdrawal. We don't know how it's going to work with the tax-free savings accounts and RSPs, if you're going to be able to make a transfer of tax-free savings account money on a tax or RSP money on a tax-deferred basis into this type of account and vice versa. Like all those logistics, they're on the Government of Canada website, but there's a bold disclaimer there that says none of this is set in stone yet. We don't know for sure if this is how the account type is going to function, but it is eventually going to be a new account type that we are going to be able to open for you if you are looking to buy a home, which is nice. And I would anticipate that the first budget release usually comes out in the spring. Sometime around then is when we are going to know more about the first-time home savings account. So likely mid 2023, late 2023 is when it's going to be an option for you as a client to be able to utilize if you are looking to buy a home. There are a few changes to tax credits, but one that I thought was quite relevant to you, since we do look after quite a few retirees, is the brand new this year, or into 2023, should I say, multi-generational home renovation tax credit. So the multi-generational home renovation tax credit is a proposed refundable tax credit for anyone who's looking to do a renovation to be able to accommodate their senior parents, and the tax credit is a 15% tax credit on the first $50,000 of renovations that you would potentially do to modify your home to be able to accommodate a senior relative. So this is nice. It's nice because quite a few people, with cost of living increases, with all the changes, with all the inflation, the Government of Canada has kind of realized that in Ontario, especially, and in BC, we've got multi-generational homes where grandparents, parents, and then kids are all living together under one roof. And to be able to facilitate higher cost of living, that's how people are living nowadays, 2 or 3 generations under one roof. Well, this new credit allows you to build potentially a new room or renovate the basement to make it livable for grandma and grandpa. And a 15% refund, I think it equates to around, a savings of around $7,500. But next year, when trades are less expensive, when renovation costs are less expensive, could be a great time to consider taking advantage of this multi-generational home renovation tax credit that first becomes available in 2023. Finally, this has been a topic for a few of you as we've done review meetings. Most people don't have debt as our clients and as retirees. But for those of you that do, it was easy for us to come to the conclusion that investing would be more beneficial for you in the long run financially if you were choosing between investing or saving money to invest or choosing to pay off debt, because debt costs were so low. But over the past 6 to 12 months, debt costs have increased substantially as rates have gone up. So, for example, a variable rate mortgage, Mark was just looking at the lowest cost he was able to find because the Bank of Canada just increased their rates. I think it was yesterday or the day before they made their announcement. But the lowest variable rate mortgage posted online was around 5%. So that would mean most of you, if you have a variable rate mortgage today, you're paying somewhere between 5 to 6%. In order to match that from an investment return standpoint, you need a ballpark before tax return of somewhere, depending on your tax bracket, of we'll call it 7 to 10% to match and to make it worthwhile. So in order to achieve a 7 to 10% return after fees, you need to be in a medium to high risk or ultra high risk portfolio, depending on your tax bracket. And in order to achieve that after fees, it's virtually impossible. So the decision is now more important than ever if you're going to be paying off debt or investing. What we're recommending to all clients, especially if you've tuned in this long to our video, is if you're making a choice between, contributing to your TFSA or your non-reg account or your RSP, or you do have some substantial debt to pay off, every individual situation will depend on, again, your income. There's lots of variables to consider. Please feel free to reach out to us. This is what you pay us for. We're very happy to weigh in on your situation and to give you some advice as to what we would do if we were you and to what will benefit you the most given, again, your situation. Mark, is there anything that you want to add with respect to this?
No, I think I'll just repeat the point that as you said, that with short-term lines of credit and variable rate mortgages, as you said, ranging from 5 to 7, when they're secured, 5 to 7%, the carrying costs, and then unsecured lines of credit are now probably between 7 and 9% interest rate. It's for the first time, as you said, Greg, for the first time in at least 10 years, you really got to think long and hard. You got to look at your balance sheet. You got to look at your debts. You got to look at your investments, and you got to, as you said, it's paying off debt quickly or faster is now something that must be considered in certain situations.
Yeah, it used to be a clear-cut winner for investing when debt costs were in, for a typical mortgage, for example, was around 2% or 2.5%. It was easy. But nowadays, those same mortgages are around 5%, 5-6%, and line of credit that's secured around 7 to 8, unsecured 8 to 9 or even 10. It's not as clear cut anymore. In fact, paying off debt could be the right option for you. So if you have to choose, please feel free to reach out to us. We're happy to weigh in and give you some guidance. With that, this is our last update for the year. Mark and I just wanted to say thank you so much. If you enjoy these, we really appreciate some of the feedback we've gotten from some of you. If there's anything in particular you'd like us to talk about, send us a note. We'll happily talk about it or try to make it a topic of discussion for one of our future updates. I hope everyone has happy holidays, Merry Christmas, and we look forward to seeing you and meeting with you in the new year. Thank you, everyone.
Happy holidays, everybody.